Just a minute. Okay, good afternoon, everyone. We are about to start today's session. You might be following me in my last couple of sessions every month, which we normally take about different market positions. So today I'm going to speak to you regarding market kya lagta hai aage. We are around about 51,000 level in Sensex, and what we feel that where will the market go? The question is very pertinent because a lot of investors are keeping their money aside. A lot of investors are booking their profit. They are expecting a deep correction, but we are not seeing that the correction that people are expecting. So today I'm going to share with you some data which will help you take an informed decisions going ahead. Another word of cautions that this presentation is not about asking you or suggesting you investment into some equity or equity mutual funds product. It is only for the information sharing. For investing in any stocks, equity mutual funds or other assets, you need to consult with professional financial advisors or you need to do your own due diligence. Okay, so this is a regulatory requirement. We do not give advices on particular stocks in these presentations. Going ahead, let us go through what exactly happening in the global market. Okay, so let us see that. In a global market, what we are seeing is that GDP growth has recovered very fast. Uh, if you see in a post subprime crisis, that is in 2009, when we have the GDP, real GDP, as well as the nominal GDP growth rate was very sharp after the subprime crisis. And here, after the corona crisis, we have seen a much sharper rise in the nominal and the real GDP rate across the globe. Now, why this thing has happened? Yes, money supply has been one of the major reasons. A lot of global banks pumped in a lot of money into their economy, a lot of given subsidies to their economy, a lot of money supply has been given to their people to cope up with the corona crisis. And that is one of the reason, and most of the reason is that, and as I go through the presentation, you will find why the company that has reported huge profit in December quarter. Surprising to many of you who might be thinking that during the corona period, market has not given the top line sales, but that much of top line sales, but still there is why there is so much of profitability in various companies. Going ahead, now we talk about the US Federal Reserve a little bit more here because they have a data of 100 200 years, and whatever the US Fed do, that generally impacted the global economy. So there has been, you have seen in the last 1 year, US has given a huge amount of stimulus package to his citizen. Even as we speak today, last week itself, the new government in US, they have pumped in, they have already approved $1.9 trillion of package to their people. And that money will go to all their citizens in next 6 months to 1 year's time. And what exactly happened when you pump in so much of money? It actually results in government budget deficit, and the US, obviously that money has to be borrowed somewhere. So US, what exactly has done in the last 1 year, they have actually increased their budget deficit numbers and they have gone for a borrowing hugely now, which has obviously put a pressure on their bond yields. And I'm going to tell you about that also a little bit and how that can impact Indian market. So this data clearly suggests that if you can see, budget deficit in US has gone significantly high over the years. Like in last 20 years, it has been highest right now. Okay. Go back to the company's profitability. There has been a solid breadth of company beating earning estimate across region. If you see the US, Europe, Japan, and emerging market, across all the countries, if you see the numbers, if you see the data out here, they have actually beaten the earning estimates. So this is not only in India; it is happening across the world. The company's earning has beaten all the previous records. Now, what exactly happened is that, as I mentioned, that the last 1 year, US has given a huge amount of stimulus. Not only US, other countries also, but primarily because of US, there's a huge stimulus, and market has driven both in the US and the global economy because of the excess personal savings. And if you see the data point in the last 1 year, you see the data market is driven mainly by the excess personal savings. And if you see the next slide itself, uh, the US, this has been a analytics, this has been a research done by the US firm, and they say the US retail investor plan to put a significant chunk of any forthcoming stimulus in the stock market. So there has been an age group, an income group, and an online investing experience, which has been found that whatever stimulus package that has been given by the given by the government in US, it has gone maximum towards the market. Okay, and they will continue to push into the market, and that is one of the reason, despite valuation is not cheap in US also, you have seen the market has gone high. Even if today as we are speak, the market is going high across the world. Okay, so what basically happened is that the stimulus package which was given by the government, the money has been pumped into the stock market. Now, what exactly happened in all of this stimulus package, all of the US borrowing and everything, their inflation rate is has surged. Surge in inflation expectation continues unabated in the last 8 years. Even in the last 8 years, the US inflation number has gone high. Okay, now this is the one of the only risk factor lies in a global economy as well as the Indian economy. Why, I will tell you later on during the slide presentations. Inflation number in US will can impact if this inflation number resulted in the Fed increasing the rates out there. Okay, so another important point is that we see the commodity pricing are rising across the globe, but it is not to that dramatic level of 2007 and 8. Coming back to the Indian economy, so or a nutshell, if we summarize the global economy, what is happening in this that US has done a huge amount of borrowing. They have increased their budget deficit, and they have given a huge amount of stimulus in the last 1 year. And most of the stimulus package goes to the citizenship, and they have invested a lot of money into the stock market out of the stimulus package. Now, as a result of this huge money supply into the market, US inflation has gone high. Now, despite US inflation has gone high, which is at 8 years record high level right now, the Federal Reserve, has not increased their interest rate. Now, what Fed chief has said, I will show you the presentation later on. They said that till 2023, they're not going to touch the interest rate numbers. Now, if that is true, I don't know how long they can hold this statement, because if the inflation continue to rise, it will be difficult for them to fund the deficit that they have. It will create a huge amount of pressure on their treasury yield. So the only risk factor in global economy rise that if the Fed increases interest rate from here, it is going to impact the global stock market, and you will see the stock market coming down sharply. So also this number will further, whatever number I have shown in the global economy, will number reduce the dollar price. And as we've seen that the crude and commodity price are slightly increasing, with only factor lies which is favorable to us is the Fed not touching the interest rate. So if the interest rate Fed also touches, you will see a sharp fall in the global stock market. But one good point which is there, that Fed chief has last week itself say that till 2023 they're not going to touch the interest rate. So if the Fed do not touch the interest rate and the inflation numbers do not rise sharply from here, I don't think so you will see a deep correction in next 5 to 6 months also. Probably in entire 2022 you may not see that deep correction, provided the interest rate Fed do not increase sharply at very short period of time. And that can only happen if the inflation, which I already showed that which is already at the 8-year high, do not go farther up from here. Coming back to the Indian economy, well, Indian economy, we are pretty extremely better position now. Government has been extremely accommodative. The budget has been extremely helpful for growing the Indian economy. I will show you the data point out here also. If you see the February GST collection, we have crossed 1 lakh collection, 1 lakh crore collection for the 5th straight months. Now, GST collection is the actual data point where you can see that how the economy is doing. In the last couple of 4 or 5 months, we have seen the GST collection is which is 1 lakh crore plus, which is pre-COVID level also. We are actually breaching the pre-COVID level GST collection also. Automakers scramble to meet the demand. There's a huge demand going on in the automobile sector. Unemployment rate, which has dropped to 6.5%, and employment rate has surged to 37.9%. This is as per a CMI report. Uh, Indian manufacturer PMI remains steady in February. Services PMI rises to 55.3 in February on boom domestic demand. So these are some positive remarks which is coming up from the market in the month of February. Now, another positive point in India is that, as per the report from MCA, company registration in India has jumped 21% from April to December month. Okay, if you see the data point, in April to December 2018, we have 89,000 companies which are incorporated, which has increased to 93,000, and now it has increased to 1,13,000. So a lot of companies, like this growth has basically because of the progression of smaller firms and limited liability partners towards forming companies. So a lot of people are forming companies. The company registration has increased over the last couple of 7 months. Uh, this is another important data point. Indian public debt to GDP has been significantly low compared to other countries. Now, when we say that how India is doing now, if you compare India with the other global economy, you will find exactly where we stand. This number is very important. Like Indian public debt to GDP, if you see the Japan and if you see the India, is much better off positions. Only Argentina, Indonesia, a little bit doing better than India. But apart from that, government debt to percentage of GDP and private debt as percentage of GDP is extremely low in India, apart from any other countries in the world. This is some of the government reform momentum to bolster potential growth. I have already discussed this thing in my last month presentation. In case you want to go back to my budget decoded presentation, you can refer to our YouTube channel, Nayakfin YouTube channel. You can get the data point from there. I'm not going to discuss more about this. Uh, Now, this important data point which shows that we are nearly having a V-shaped recovery after the Corona period. Business activity, order books, as well as the output prices, we are having a V-shaped recovery from March to January 2021. So this is a positive from Indian companies' perspective. And Numera India Business Resumption Index is almost at the pre-pandemic level. So that is something which is better off because we have seen that the Indian Business Index is already going to the normalcy right now. Real estate, now only one factor is that we are having affordability of real estate at all time high and the mortgage rates are at all time low. So that is the only factor that real estate has not picked up, but it will slowly pick up from here onwards because we have a rates which is a much lower level and affordability index is also low. This is some data point which is get from the SBI and SDFC. Uh, Now, again, the budget thing, why I'm mentioning this thing is that in the budget 2022, we have seen there a lot of emphasis on going towards the infrastructure capex spending on the budget, which is obviously good for the Indian economy and which you're going to see that results in the days to come. Now, having said this Indian perspective, now we're going to talk a little bit about what are the risk lies in India. So we have already mentioned the risk lies in global economy. Now, what are the risk lies in India? So let us take that for instances. Now, COVID cases is slightly on a rise in the last 10-15 days. That's a worry, but I don't think so. It will be a much bigger worry because we already have a vaccine, and in next 5 to 6 months, probably most of the Indian will get vaccinated and though this may not rise to a considerable level, but it still remain a risk if new variant come into place. That can be a risk element. Second important thing is inflation. So I am already mentioning point again and again is that where will the market headed to? Upside, downside. You don't need to see any data point. Just see what the inflation data point is there. So if you follow the inflation index, you will understand where the market is going to be. As far the data goes as for January end data point, we have seen that both CPI and core CPI inflation and uh, CPI inflation and core CPI number are basically in the range of that we had expected. Normally, RBI has mentioned a upper limit and lower limit for the tolerance band, which is 2% to 6%. We are nearly about that. A slight increase in inflation in February, you might be seeing in the next one data point. Uh, because we have seen the crude price has grown, we have seen the petrol and diesel price in India has gone high for some other reason, and so that will be worry. But still, it is not to that extreme worry level where we can think that market will go a sharp decline from here. So if you see this blue mark, if it is touches near the 6% level, then it's a real worry. Okay, so this need to be constantly followed up, and actually this particular data point, this particular graph will give an indication where the Indian stock market will head. RBI survey recently has conducted, which is saying that confidence is still lagging in the market. So, despite having all those positive points, the confidence is lagging. But if you see, it has slowly increased in the month of January, and in February it has increased a further little bit up. So probably in the March 16 to now level, we have 50% down, but it's slowly increasing. Obviously, in the last 8 9 months, we have been staggering. All the people are at home, so it has impacted a lot. But it is slightly increasing, and this data point will further increase as we go ahead from here. Another important worrisome risk factor is that we have seen that unemployment rate is down, but the income of individual has not increased. Okay, so that's a worry point out there. And I hope as the market opens up, this income level will also increase. Now, what exactly happens is that when the income level increases, it increases more top line activities from the companies. So that is need to be taken care of. We hope that it will increase from here on. Now we go to the Indian equity market. Okay, so now why the market has gone up like 51,000? This data point clearly shows that in the last 1 year, the most of the FI inflow has come towards India. Okay, apart from India and Brazil, every other country, if you see in emerging market, they have pulled out the money. Only India and Brazil, they have FIs have pulled out a lot of money in the last 1 year, and India has been exceptional and phenomenal out of this thing, and that is one of the reason why Indian market has gone high to this level what we are sitting right now. And as we speak, this month also FI has inflow a lot of money into the market. I mentioned earlier that US government has infused 1.9, has already approved $1.9 trillion package last week. So that money will come obviously, and the data point which follows is that most of the US, they think when the money will come to them, the stimulus package will come to them, they will put it in the stock market. Stock market where? That has to be in India, right? Why I am saying this thing, my data point will tell you that Indian market cap to GDP. Okay, just wait, I'll show you the data point. uh, Okay, so Indian market cap to GDP is 104. So this is 104, which is a slightly bit averaged, above average. But if you see that market cap to GDP of US, it is 150. So US market, this data actually tells you that which market is most costly and cheaper. So if you compare US market with Indian market is still very cheaper than compared to US market. This market cap to GDP in US is 150, whereas in India is 104. So it is much cheaper right now. So if the stimulus package comes there, a lot of people will put into Indian market rather than putting into the developed economy. Okay, and performance across sector. Now, this slide is a little bit important. We have already shown that large cap. This is a large cap. This is a mid cap, and this is the small cap index. Now, in this is a one year data point. This is a 3 year data point. Now, if you see the 3 year data point, which is at a green level, you see the small cap index 3 year data point is still negative. So you know what, where the money so if we see in a large cap and a small cap level, the small cap index is at a lower level. The valuation in small cap is still negative in 3 years period. So it is a quite attractive for you to pick up a good small cap companies right now to invest in, um, considering the valuation of the small cap index is still negative despite the market reaching at a 51,000 level. Okay, so we have given a sectoral performance here. You will see the more small cap index and all this data point out here. Pharma, FMCG, metal. This is sectoral performance CY20 and private banks and all. I will tell more details about this presentation in subsequent slide. So just refer to this point. Small cap index is still negative in 3 years data point. This is an important data point. You should stay a little bit more on this thing. Now we have done a research report on 193 companies where in December quarter where sales was expected -2%, but actually 0%. There is no sales growth out there. EBITDA was, we are expecting that 15%, but it has actually grown 19%. profit after tax was expected at 17%, but has grown on 31%. Now, why this thing has happened? If you even if you see the Nifty 50 companies total consolidated data point, you will see the PAT, which was expected at 7%, which has grown at 22%. Why this thing has happened? Understand, in the COVID period, the companies had become much more linear and smarter. They have reduced a lot of cost by way of cutting employee cost, by way of cutting the infrastructure cost. A lot of people are working from home, so they have cut cost a lot, and that has resulted in the profitability coming up. Although the top line has not increased substantially, top line remain more or less same, but due to increased reduction in cost cutting, they have resulted in a huge profitability. In the subsequent data point, you will find that the top line is going to increase much better from here. So we have a cost cutting. The company has become smarter and linear, and we have a better cost structure for the company. And if the top line grows from here, you see the data point, the PAT and the PAT figure will much increase from here. And that's why, understand the P ratio. If you know a little bit about the P ratio, which seems to be a quite higher right now. Now I show you the data point again. A minute. If you see the P ratio, PE ratio of NSE 500 companies, 39.9. Now in December quarter, the all consolidated earning is 2,09,000 crore. So if you see this data point out here, now obviously this data, if you see the overall data is lesser, because in March, June and September we have a lesser PAT. But if we take this 2 lakh data point and stretch it to the whole year period, which is going to be there in 2021, because the top line is going to increase, it will not be as less or subdued as remain in 2020. So it will have a higher PAT, and when we have a higher PAT, the P ratio will automatically comes down. Okay, so at the 51,000 level itself, we are expecting the P ratio to come down drastically in 2021 end. Uh, in provided we have a huge amount of top line growth coming up in next one in this year itself, and top line growth will come up. The data point actually tells that. So going back to the previous slide, uh, we are okay. So next slide, we have said that there is a significant profit pool expansion seen in PSU bank, cement, auto, and auto ancillary and metal. Okay, so if you see the data out here, you know this this blue line is previous high pre-COVID level, and this is from September quarter. This is a profit by sector. If you see the PSU bank, there's a huge profit. Cement, they make a huge profit from September 19 quarter. Okay, and similarly the metals, material, FMCG, uh, utilities, they have made the losses in last from this quarter itself. So as I mentioned, that this PSU bank, cement and auto ancillary and metal, this will continue to rise from here. They have made profit from September 19 quarter, basically on a reduced cost. And as we grow ahead from here, as we the top line is bound to get increased, because most of the people are coming back to the normalcy with reduced cost, a leaner company, the PAT will going to increase in all this company and will reflect in their PE. So the price, whatever you're saying right now, which might looks higher, but with the reduced PE, that will look attractive going ahead. Nifty earnings are expected to accelerate sharply over the next 2 years. This is a company research data point, IIFL research report. Uh, okay. And valuation wise, what we are saying that we are neutral ways, momentum wise we are overweight. So what we are telling is that do not sell all your equities. You can book profit on wherever you're sitting in an excess position right now. I have already mentioned this data point. Valuation are at a higher end of a fair value. If you see the 1 year P, forward P, and 1 year forward PB, it is nearly a little bit higher than the normal average, but it will come down, as I mentioned you earlier, because of the increased PAT this year end. You will see the P will automatically reduce from here on. And now if we take the sector wise analysis out here, I have done a little bit of deeper analysis. If you see the automobile sector, this current PE is 23 and 10-year average is 15.8. So you are getting automobile sector as a whole. There can be company which is a lower PE or a higher PE at a premium of 46%. Similarly, if you pick up the metal companies, 10-year average is 10 and the current P is 9.3, you're getting at a discount of minus 9%. Similarly, energy ex Reliance Industries is minus 11% discount you're getting. Utilities companies, you're getting a price of minus of discount of 27%. Okay, so this data point actually tells you is that which companies, which sector precisely you are getting a discounted price, and which sector you are currently are buying at a premium. So say for example PSU Bank, it is again minus 6% discount that you're getting. I given a call to all my investors couple of months back toward the SBI, and it has given 100, is a doubled, it has given a mammoth return in last 2 to 3 months time. So this does not suggest that you keep on going and buy SBI right now. Just a normal data point which I'm mentioning. Going ahead, I already mentioned this data point. Valuation are not as perceived. High Nifty valuation conceals the bargain opportunity in select quality stocks. So if you see if you see the PE of Sri Cement, Ultratech right now, which is extremely high right now. Okay, and what I have mentioned already is that going ahead, this will reduce because of the reason which I mentioned earlier, and you will see a much better P ratio in all of the companies, and they looks attractive. Okay. Uh, so adjusted P ratio for profitable companies, quarterly data annualized. So if I take the December quarter data and annualized it, so it doesn't look extremely expensive. Okay, adjusted P ratio profitable companies. If you see the data point, adjusted P profitable companies, it is nearly about the average rate. It is 24, 25 or 22 to 25 level, which is nearly at adjusted level. So the companies which so the top companies which you are buying right now, it's probably at a same rate that you are exactly that expected with the adjusted P ratio. I just wait for okay. Now, what are the changes that are going to happen in days to come? Now, one interesting change which is going to happen from 1st April in Indian stock market is that we have a different way of calculating P ratio. Till now, the P ratios are being calculated on a standalone basis. So when we talk about the standalone basis, so Tata Steel, okay, so we talk about the Tata Steel P ratio. Okay, so now going ahead, the P ratio will be calculated on a consolidated basis. So Tata Group P ratio will come up. So it will include Tata Steel, TCS, and all the company which Tata Group will have, as well as the overseas also. So that is going to change, big change from the April onwards, and you will see the PE ratio re-rated, calibrated in across all companies. Okay, so what are the plus and negative point out of this thing? The positive is that a mandatory reporting of quarterly consolidated data provides a realistic picture of total earnings. So it will actually give a realistic picture. Right now, P ratio of only domestic companies or one companies are reflected there. So you only see the P ratio, it only sees the domestic earnings of the particular company. Right? So going ahead from April, you will have foreign earnings also and the consolidated group earning also as an overall P ratio. So previously, all companies were not required to publish consolidated earnings on quarterly basis. So comparing history will be difficult from now to previous. Okay, many companies are profitable at group level. Consolidated earning for such companies is higher. This increases the index level earning, making P ratio go down. I mentioned this thing earlier also. One point is that the top line sales will make the P ratio go down. Another point is that the calculation change for the 1st April onwards, because of being a consolidated earning, the P ratio will further go down. Companies earning, some companies have losses in certain business at group level. So just to say, for example, Sun Pharma suffer losses on a standalone basis. However, it turns profitable when earnings are taken at the consolidated level. Consolidated level means across all subsidiary businesses. So when we talk about similarly, Tata Steel is profitable on a standalone India business, but consolidating losses in global subsidiary Chorus Hearts is earning considerably. So those are the plus and minus point that has to be taken care of, but it will give actually a holistic picture of a one company, including all its subsidiaries going ahead. Now, this is an important data point I mentioned earlier also. The Fed chief has already mentioned very clearly that they will maintain the status quo. The recent hike in rates was notable, but stressed the central bank would continue the pace of bond buying and low level interest environment until substantial progress is made on its job creation and inflation goals. So, what is that now? The Fed is saying that until there has been a substantial job creation, they are not going to increase the interest rate, and report suggests that till 2023 they will be accommodated towards the Fed rate. So if the Fed is going to remain accommodative till 2023, uh, there cannot be a very sharp deep correction in the market. So right now, I already told you about that the Indian stock market is looking extremely positive with all the data points. The only worrying factor is that the inflation point from the from the international market perspective. Okay, so but Fed has already said that till 2023 they're not going to increase the interest rate. They will maintain the status quo until unless the huge change in the inflation number comes up. So I think that this point has to be taken care of a little bit more, and there is no such worry that we can see a heavy deep correction from now on, provided the Fed change its stance overnight, which is unlikely to happen. Uh, as you can see that in the last 1 month, uh, January to March, the foreign equity investment in India has gone up, and they have reduced their investment in Indian debt markets. Okay, so this number shows that they have invested hugely in Indian foreign market, and they have been negative in the Indian debt market. So they're pulling out money from the Indian debt market and putting in the Indian equity market. The question comes here is that so that's about equity market. I have mentioned and summarize the equity market. The companies has become leaner and very smarter. We although the top line has not increased, the PAT has increased in the December. Profit after tax has increased in the December. Imagine with the top line increase in entire 2020-21, the PAT is going to increase further from here, resulting the P ratio to push further down. So that is a good point of view. And with so many infrastructure funding been laid down by the government in their budget speech, uh, we expect that market will take a monumentum scope from here. Even the Nifty earnings estimate for the next 2 to 3 years is going to rise from here. Okay, so that positive news from the Indian market. Now the question comes to mind that should we invest in gold? Now, when we talk about the gold, like a couple of things. Now, why gold price is coming down? We already knows that the import duty results. Last month, I've already mentioned about this thing in details. So the one factor is an import duty. Second is that the yield in India, the government 10-year GSEC yield in India has risen a little bit in the last 1 or 2 months. Okay, so when the interest rate increases, the gold price always falls. That's number two reason. And third reason is that whenever there is a pressure on currency in the international market, people used to buy gold. Okay, so people used to go to buy a safer instrument by of gold. But today, as we speak, we have an alternate to gold by way of crypto. If anyone might be following the crypto market, cryptocurrency, Bitcoin and all, it has increased from $1,000 6 years back to $56,000 today. So what exactly happened is that people are putting a lot of bets, a lot of investment in crypto rather than putting money in the gold itself in the international market. And as a result, the gold price normally increases because of the demand because supply remains static. So it has resulted in that. So we further believe that gold will remain a neutral position. I always mention that if you have 100 rupees in total asset, 5 to 10 rupees has to be in gold, not more than that. So you can do your asset allocation basis on your financial condition right now. And but precisely, if you are underweight in gold as far as the 5% of your overall asset, you can increase in gold. But otherwise, I have already mentioned there is no point that you can put a lot of money into the gold right away. Now, debt market outlook, liquidity is here to stay. I mentioned that already mentioned that a lot of money has been infused by the RBI also, and you can see the next data point. OMO operations, just wait for a minute. Yes, the RBI is going to infuse a lot of money through open market operation also. So you don't have to worry about the Indian liquidity. We will have a huge amount of money supply available in the Indian market. So that is not a worrisome out here. And the second point is that the FII has been pulling out money from the Indian debt market. I showed it earlier also. That's a data point over the last, 2 to 3 years time. You can see the data out here, and debt market is normally move according to the inflation number. I mentioned that the inflation number is moving around 4 to 5% level. So it will remain a little bit of range bound. And the RBI has already mentioned that during 2021 or 2022 is a longer time. So 2021, they are not going to increase or decrease rates further. So it will remain more or less static. We can expect a little bit of bond yields movement because of enough money supply into the market, because of huge government borrowing program of India also, because of the OMO operation. OMO operation will actually curb it down, but you can see a little bit of rate hike in the 10-year GSEC, which will happen because of the market movement and not for the RBI intervention. And when the rate and the GSEC yields moves up, the interest rate goes down. It goes in a reverse direction. So as a result, if you are invested in government bonds or debt funds, you need to be a little bit cautious about it. I will recommend you to go for the lower term bond paper right now instead of going in a longer bond paper right now. So if you invest in a longer bond paper and the government GSEC 10-year GSEC yields goes high, you can get a much lesser return, like 1 or 2% also. So go try opt for a low duration liquid fund or ultra short term fund right now. You will get a pretty decent safe side return from there itself. So this is going to be a neutral factor throughout the year. It will remain range bound. You will not see much movements out here, and that is exactly happened why the FIs are pulling out money from the debt markets. Debt markets has given phenomenal return in last 1 year. In 2019 and 2020, we have seen 12 to 15% return in government bonds because of the rate going down. So we don't see further rate going down. We can see a very marginal rate hike, not from the RBI point of view, from the market point of view. So that's why the debt market will be remain a normally neutral stand throughout this 2021 sector. Only option available right now, the low duration government bonds you can invest in. Uh, so that exactly precisely I mentioned this thing. And overall, this is the normal impact of the economy and all those points. Couple of points which I've mentioned right now. I already mentioned the profit, mentioned small cap index, corporate India, global interest rate, US market, sustained deficit. So another point which I want to mention is that Indian government next 2 to 3 years, they are going to raise 2.5 lakh crore, from the market by way of IPOs, by way of selling stake in IDBI, and a big mother of all coming LIC stake is also coming up, probably this year end or next year beginning. So 2.5 lakh crore money is going to raised by the government, and that is a huge amount of money which will be there into the market. So I don't think so. When there is so much of money supply, government is aims to take so much of money from the market. You can see a huge deep correction from here. Government will not try to have provided the inflation number, which is obviously not in the government's hand. Doesn't go heavy. You don't expect a very deep correction from here. Okay, and a couple of more points. If I mention banking, infra, and PSU and metals, you should look after for investing right now. I already mentioned what are the sector which are in discount right now and what are the sector which is available in premium right now. And any other point? Okay. Okay, it's not much point from now on. I have mostly covered all my points out here. And if you have any queries, you can drop by. I have given the link in my chat box. If you have any queries, suggestions, feedback, reference, you can already go back to the chat box and write it out here. I can talk to you personally also. You know me. And so on a summary, I can say that from here on, the market can take. So, क्या लगता है market आगे? I can only say that from here on, market can go for a very sharp correction only and only if the Fed intervenes and increase the yields out in the international market. So what happened is that if the Fed increase the market interest rate, the FIs will pull out money from the India. uh, the factor is that the inflation number is US is increasing, and that's a cause of concern. It will increase obviously because they have infused so much of money into the market. But Fed has been quietly very accommodative, and they want to remain status quo till 2023 because because the employment situation in US, the job creation is not that great. And if they increase interest rate from here, that will hammer their industries there itself. So that's overall. So equity, we are at a extremely neutral position right now. We are not saying to go and aggressive buy equity. Whatever return that you have get in the last 6, 7, or 1 year time, it's phenomenal. I am sure those who have remained invested get phenomenal. Don't expect that phenomenal return in next 2 to 3 years. Okay, but yes, in a longer term, I can only say that India, I can only predict that Nifty will going to touch 50,000 level at 20 to 30, and that quite possible. I can have a sessions about that in next other time. Uh, but in a shorter term, the worry remain in an inflation number. Fed says that 2023 they're not going to increase interest rates, so that's been ruled out. In case they take somersault in very sooner and increase the interest rate. So for investment right now, you can go with an asset allocation. You check your own asset allocation and do remain invested. Wherever you have a huge profit, you can book that profit. I have already mentioned sector wise. I have already mentioned not company wise but segment wise, which are segmented looking positive and negative or premium or discount. You can take a call accordingly to that. And remember that staying away from the market is more riskier than remaining in the market. Even if you buy equity at that level in a good companies, if you buy at that level, probably it will take a little longer time to give you the return, but the return will always be higher than your return expectation in fixed deposit or any fixed income instruments. Okay. One thing I say that in gold, if you have invested in gold every day, you can see there are some days you can see that 2 to 3% increase or decrease in the gold price, which they won't panic. Or whenever there is an increase or decrease of 2 to 3% in equity market, the investor panic. I don't find the reason for that. In 1979 till date, sorry, there has been a year on year 13% growth in Indian stock market, and that's phenomenal. That's a long term, and we hardly see equity investor remain that longer period of time. So if you stay, if you buy good companies, stay for a longer period of time, you're going to make money. And for trading or short term calls, I've already mentioned a couple of things which you should take into consideration before investing right now. For any query of investments or your existing asset, you can drop a query box. I have already mentioned in the chat box, and I will get back to you in that thing. Thank you. Thank you for attending this thing. Till the next time we meet. And thank you. Thanks.